Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We are bringing the VRIC to you each and every week with our series of expert online panels. I am very excited for the one we are here to present you with today. We've got David Hay, the Co-Chief Investment Officer at Evergreen Gavical, and Louis Vincent Gauve, the CEO of Gavical. We're going to discuss the gold and silver markets, what's going on with oil, the best ways to participate in China's bull market, and much more. Gentlemen, it is an honor to have you back on the show for round two.
Thank you, Jesse. It's a pleasure to be here. I love your last name. It really
Thanks again
fits
for
well
having
with
us.
mine. It's a
Absolutely.
heyday.
Well,
We're gonna have a heyday today.
a heyday. Let's
We
do
have a
it.
heyday.
And Louis is actually close to my hometown right now on Vancouver Island, so that's cool. We've all got a connection here. But I do want to kick things off with your thoughts on the gold and silver markets. Obviously, a lot happening since the last time we spoke. Gold, new all-time highs. Silver showing quite a decent amount of strength, hovering at 30 or just over $30. I'm wondering what both of your thoughts are on the gold and silver markets. And David, I'll start with you. Why don't you intro it with this slide?
This visual, our good friend Ron Paul, who's been warning of our current predicament for about 25 years, and the national debt. I can remember, and maybe Louis remembers this too. In the early 2000s, they actually turned off the national debt clock in Times Square because it was going backwards. And that's when Alan Greenspan was afraid that we were going to have no treasury bond market by 2010 because we were going to pay off all the treasury debt with those surpluses that were running at that point. And of course, it's flipped exactly the opposite way and horrifically. So I think any discussion of gold and silver, you really need to focus on the U.S. national debt and the ultimate horror story that it's become, which is appropriate leading up to Halloween. So, Louis, I'll let you take it from there.
Sure. I think anybody who worries about government debt disappearing, it's a little bit like a second marriage. It's the triumph of hope over experience. But no, look, I think when we look at gold today, we've obviously been, or silver, much more so gold. We've obviously been in an impressive bull market. I might be mistaken on this, Jesse, but I think actually, if you look at the year-to-date returns on gold, I think you're over 30%, which is one of the best years for gold ever. Uh, so it's an impressive bull market, and what I think is interesting is even if you look at recent weeks when the U.S. dollars bounced back a little bit, when bond yields, long-term 10-year bond yields have moved back from 350 back to 410. Usually these kinds of hurdles, 60 basis points at the long end. Usually these kinds of hurdles you would expect gold to sell off on, and it really hasn't. And I think, this highlights the very structural nature of today's gold bull market, which is linked to partly the debt situation that Dave just highlighted. I think it's linked to the fact that foreign central banks are very, very keen buyers of gold. And, the great thing about central banks is when they decide to buy something, just like treasuries in the past, they're buying gold today. They're kind of price insensitive buyers, right? They come into the market, they buy a little bit every day. And that, to me, by the way, explains the massive outperformance of gold versus silver. I think when you look at the Thai central bank buying gold, the Chinese central bank buying gold, the Indonesian central bank buying gold, they're buying gold, they're not buying silver. So you've got the central bank bid, which I think partly explains the outperformance of gold versus silver. I think you've had massive buying from emerging markets in general. I think we discussed this last time, Jesse, but gold is also a derivative play on emerging markets. When people in China get richer, when people in India get richer, when people in the Middle East get richer, they very often they buy gold, either because they don't trust their governments or they don't trust their banking system, or even just for cultural reasons. So when emerging markets do well, gold does well. And today, I think emerging markets are broadly doing better. So, I think everything is aligned for a gold bull market, and it's unfolding in front of our eyes.
Well, to Louis's point, I think what a lot of people aren't aware of is this visual here, which goes back to when I think you could argue the big gold bull market erupted. And I think you could win a lot of money betting people that the S&P, even including dividends, is actually down from where it was 25 years ago, adjusted for the gold price. And so I think it lends credence to a point that actually Louis's father, Charles, has made a lot, which is this kind of money illusion. In fact, I wouldn't say it's definitely a money illusion that's gone on with the S&P 500 over the last 25 years. And you might say, well, that's not fair to compare because you were at a bubble peak back then. Well, I think we're at a bubble peak right now. Actually, by a number of key metrics, the S&P 500 and NASDAQ are more expensive than they were even in early 2000, which was considered to be the biggest U.S. stock market bubble in history, exceeding even 1929. So it's, I think that's pretty indicative that we're in a very different environment and have been. I mean, obviously there was times where gold traded poorly. There was kind of that mini bear market from 2012 to 2019 or 20, somewhere in there. But in general, gold has been kicking butt, and silver has lagged. But I did hear a podcast here recently with somebody who knows way more than I do about silver, and he was maintaining that if you look at demand by 2030 for silver from all these new sources, whether it's solar panels or EVs or the grid build out, that silver mine production will basically all of it will go to those new usages. So 100% of silver mine output over the next 6 years or so is going to go to these new forms of consumption. So, typically when you get into a precious metal bull market, silver outperforms. So it could be that it's a coiled spring. Unlike gold, it has not made a new all-time high. It's made multi-year highs. I think it's the highest it's been since 2000. Well, basically since the late 70s, early 80s when Hunt Brothers tried to corner the market.
Real quick break here, guys. If you are a mining investor, you are without question familiar with the Golden Triangle region in British Columbia. This is one of the most prolific mining regions in the world due to its vast deposits of gold, silver, and copper. Now, for the last 4 years, Dolly, Varden Silver has been busy expanding their high-grade silver deposit in the Triangle, and they are backed by some of the smartest investors in the silver business, including the legendary Eric Sprott, Hecla Mining, U.S. Global Investors, Fidelity, Delbrook Capital, Sprott Resource Corp, and more. If you are curious why the smartest money in the silver business is cozying up to Dolly Varden Silver, then hit the link beneath this video.
Just to finish up on what Dave was saying, few people realize this, but actually, if you look at even without going to the equity bubble peak of 2000 and the gold low of 2000, since 2018, gold and stocks have done the same thing. So indeed, going back to this money illusion story, if you measure the S&P 500 in gold terms since 2018, you've really done nothing.
And I just want to follow up on this, impending demand when it comes to silver. Silver and solar has been two things that have really gone together. A lot of analysts proclaiming that, silver panel construction is going to require so much silver. I've heard Andy Scheckman actually talk about silver's use in wartime technology, Tomahawk missiles, etc. But when it comes to the more kind of ESG side of things, the whole green revolution, we're hearing the same thing for copper. Copper is going to be so massively in demand because of the energy transition. Do you think there is actually robust demand coming there from the energy transition, or do you think some of that modeling out to the future could be inaccurate or exaggerated? What are your thoughts, Louis? I'll go to you first.
I think for me, one of the most important tweets of the year came in February when President Biden tweeted that he was imposing 100% tariffs, 200% tariffs on Chinese EVs, 100% tariffs on Chinese batteries, 100% tariffs on Chinese solar panels. And so what did this tell you? I mean, this was the same guy who, during the campaign, was telling us that we only had a few years to go before the world would melt down if we didn't embrace a Green New Deal, if we didn't do massive investments in solar panels and whatever else. And now all of a sudden, these same people who were arguing this just a few months ago turn around and say, actually, you know what? Don't worry about the environment anymore. Don't worry about solar panels. We don't want to put in cheap batteries, especially if they come from China. That was basically the message. So I think what's happened in the past few years, to your point of, oh well, all this demand from alternative energy may not be what it might be, is that what's happened in the past couple of years is we've realized that when it comes to all the alternative energy solution, whether in EVs, whether in batteries, whether in solar panels, whether in wind turbines, we've actually been leapfrogged by China. And that's the reality. China is now producing, we can't compete with Chinese solar panels. We can't compete with Chinese EVs. So we have two choices. Either we say, you know what, the world isn't going to melt down after all. We don't need to go down this path of alternative energy, or China is going to own the space. And that's it. Those are our two choices. And so what are Western policymakers doing? They're turning around and saying, you know what? Forget climate change. Forget everything that we said before. We'll put tariffs on China and forget the alternative energy thing. Forget that we ever mentioned it. That's where we are now. Let's not kid ourselves. That's what's unfolding in front of our eyes, because which basically tells you that it was a hoax to begin with. And we now find out that because we can't compete, we're quietly abandoning it.
And David, your thoughts?
I'm just smiling because Louis was brave enough to use the H word there. Hoax. Yeah, I mean, I think it's going to happen. The energy transition is going to happen, but I think it's taking a very different form. And obviously, one of the completely unexpected winners out of the developments that Louis just described is nuclear energy. Tremendous renaissance and tremendous momentum behind it. And the problem is that, once again, China's in the lead, along with some other countries like South Korea and Russia. So we're trying to play catch up for a country that once was the dominant builder and had the biggest share of nuclear energy, other than France. France was obviously the biggest from a percentage standpoint, but we were way ahead in terms of the number of nuclear plants operating at 100. Now we're down to the low 90s. We're now starting to reopen some of these formerly mothballed plants, including 3 Mile Island, if you can imagine that. So I think there is a tremendous nuclear renaissance going on. Obviously, uranium has been a big winner and probably will continue to be a big winner. I think we're in the EV area, what's happening, and I don't think this really improves the U.S. competitive situation, is that it's now shifting towards hybrids. And I think Louis agrees totally with that the hybrid solution makes a lot more sense than pure EVs. But China's wickedly competitive there. And I think that's one of the problems we've got with the whole great green energy transition, is how much of a lock China has on the key components and now even the key end products. It's not like they're just a commodity producer anymore or a processor. They're making, the final products and making them very high quality and very inexpensively. And I think that's why you're seeing this tremendous tariff backlash. So, but it's going to happen. And I think there are going to be some clear winners. And one that I think you and I talked about before, Jesse, and I think Louis is still bullish on too, is palladium. Because palladium is viewed as a victim of the EV transition. And actually, it's a big winner by shifting to hybrids, because hybrids actually use more palladium than do even internal combustion engines.
Both palladium and platinum have been left in the dust. Palladium more so than platinum, but both have been left in the dust, and both are winners from the trend that Dave's highlighting. But I think, when Dave says that, we in the Western world have been left in the dust, I think he's being somewhat unfair, because we've been world leaders in EI, and we've also been world leaders in ESG. And, if diversity is our strength, then, who's stronger than us? So we have nothing to worry about our future competitiveness. We should be doing great.
Yes, absolutely.
A little sarcasm there.
Yeah, but particularly my home country of Canada, where you're at right now, is certainly leading the way in that regard. I do want to switch to discussing the oil markets, because they've been quite interesting recently. WTI crude prices running up, seemingly on headlines that the war in the Middle East could escalate and Iran's oil production could be targeted. At least that's what some analysts are saying. Still looking fairly strong, above $75 at the time of this recording. There's been some people who are calling for $50 oil. I've spoken to some people who say we're going to $30 oil. And I know, Louis, you're bullish on oil, and so are you, David. I just wonder, do you see perhaps a short-term correction on the horizon? How do you see this all playing out? One of the bigger questions I want to ask is, how much does this geopolitical risk actually play a role in the oil price? Because we see short-term fluctuations. Could we see longer-term implications based on things like expanding global conflict and things like that? David, you've prepared this great chart, so I'll start with you on this one.
Yeah, and there's a lot of ways to look at speculative interest or positioning with oil. And this is actually probably not as dramatic as some of the other charts out there, but it tells a story. That red line became very, very short and non-commercial, the blue line as well. And that really kind of hit a crescendo here recently. And that was kind of the early September, mid-September period. That's when Jim Cramer was on CNBC telling everybody oil was 65 at the time, and he said it's going to go lower. And then you had this. So you had a tremendous amount of negativity as shown by this positioning. And by the way, in the oil market, the derivative market, futures market is like 40 times the actual underlying cash market. And other commodities, it's more like 3 to 5 times. So what's happening in the paper market tends to have a very exaggerated impact on the actual physical oil market, or at least the trading of physical oil. Now, the actual consumption is a different story, and we can look at that in a bit as far as the supply versus demand. And Cramer was saying there's no demand, there's too much supply, oil's going lower again. That's when it was 65. And of course, it then had a very powerful rally. So when you get that negative sentiment and negative positioning, and then you have something like, what's happened in the Middle East occur, and, that's going to happen on a regular basis in the Middle East. It's such a powder keg. So then oil just goes straight up. And, what we typically do when that happens, we being Evergreen, is we tend to take some profits into that kind of a move and wait for it to retrace. And so I'm personally expecting a bit of a pullback in oil right now, but I think it'll be a pullback to be bought. I think where we're really bullish is natural gas, and natural gas is actually even more depressed than oil if you look at it from its high to its low. And the demand for natural gas is absolutely going through the roof. Louis was talking about data centers and how the U.S. leads in data centers. I saw a chart from Liz Ann Saunders here recently. We have something like 5,400 data centers in the U.S. The next country was somewhere around 500 or 600, and we're building them like crazy. And those are energy hogs, particularly the AI data centers, which use as much as 10 times more energy than the traditional data centers. So it's, we got to come up with that power. We've also got LNG, which is an absolute bull market. U.S. natural gas is so cheap that even with the transportation costs, it's still a bargain for Asia and for Europe. And I think Europe's due for a cold winter. If that happens, you could really see a spike in natural gas prices. So that's my quick little take on both of these. Well, I should show one more here, which is on the, oops. Sorry, I'm losing this one. Well, Lou, why don't you take it from here while I try to find my right slide?
Sure. Look, I don't disagree, of course, with anything Dave just said. What I would highlight is that I think what we've seen in recent quarters is a massive liquidation of inventories everywhere. So you've got basically record low inventories in the US, and you got probably record low inventories more or less everywhere except for China, for a pretty simple reason. It's that funding costs have gone up a lot. When you can borrow at zero or thereabouts, why not stock a bunch of oil? But when all of a sudden, cost of funding is 5, 6, 7, 8%, and again, that's been the case everywhere. Cost of funding's gone up everywhere except China. Then your likelihood to keep inventories goes down. So especially if, as you highlight, the perception out there is, oh, well, there's a lot of oil in the system. Saudi Arabia is going to turn it on at any point. Oil's going to end up at 50. The Wall Street Journal just told me so. Why would I pay up today to store up and pay high interest costs to store up oil? It makes no sense. So today we have a situation where not only is there no inventory in the system, but as Dave highlighted, you basically have record shorts in the market. And that to me seems a pretty dangerous situation. Of course, you got the geopolitical element, but you also have China that's now stimulating fiscally and on monetary policy front. You have the US that is cutting rates, and after the election, almost regardless of who wins, you're going to get fiscal stimulus because, that's what happens nowadays. All you have is governments, politicians trying to outdo each other and promising things to voters. You've got the ECB also cutting rates. So you're basically seeing stimulative policies in all three major parts of the world. And so, and again, record low inventories, very high stimulative policies. And to me, that seems like a setup for higher prices. Now, having said that, I think you look at oil the past couple of years, we've basically been range trading between 70 and 90. We get close to 70, everybody jumps up and down saying, oh, we're heading to 50, it's going to break out, it's going to break down, it's terrible. And we get to 90 and people jump up and down saying, oh, oil is going to crush global growth, etc. But, if anything, I think the risk, I see more upside risk than downside risk. I would say that as long as we stay between 70 and 90, it's a happy place for the global economy. It's a happy place for most producers. Nobody goes bust. Everything goes well. But I think given the underlying situation, the risk is very much on the upside more than the downside.
And just to chime in with what Louis said about inventories, and that's what my next slide was supposed to be, a rogue slide to get in there, but it was supposed to show kind of the official inventory levels, which looked to be somewhat low, but not alarming. But that's only because you had almost 300 million barrels that was dumped into the market from the Strategic Petroleum Reserve. So when you back that out, and obviously you just can't keep doing that, and I would argue with the geopolitical situation is uncertain and dangerous as it is, that you probably should refill that SPR even with our tremendous energy independence or quasi-independence that we've gotten. And yet if you look at the press reports, this is what was really amazing during that week period in September for oil, was this tremendous disinformation campaign that started with an FT article, Financial Times, and then the Wall Street Journal picked up on it as well. And then it was all over CNBC. And one of the things, Jesse, that was just shocking, and Louis knows as well, is they were saying that the Saudis had announced that they were going to do this major effort to gain market share, basically increase volumes drastically and crash prices. And that's when you were hearing some of these $50 rumored prices occurring. And it wasn't like it might happen. It had happened. And it was absolutely false, and to the point where OPEC finally put out a clarifying statement. But I think it does kind of fit within this narrative that there's been so much effort to try to suppress oil prices leading up to the election. And with that paper market so big relative to the physical market, it's pretty easy to manipulate. So you create all these stories floating around, and then the hedge fund community jumps on it because they think they've got kind of official support and the media support. And so personally, I believe we're going to see oil trade much firmer post the election. But maybe that sounds too tinfoil hat.
No, I don't think it's tinfoil hat at all. I'd add one more point to the points Dave just made, which is that assuming President Trump wins re-election, which to me seems pretty likely for a number of reasons, if Trump wins, then you get into the question mark of, if you're Zelensky, do you think, okay, I've got a window of opportunity here to hit Russia hard before Trump gets inaugurated and cuts off my funding? Do I go all out and hit Russia's oil infrastructure? And I think there's a possibility he does that. And by that point, today, the Biden administration is telling Zelensky and Netanyahu, don't hit the Russian and Iranian oil infrastructure, because the last thing we want is an oil price spike just before the election. But after the election, does that open the door for a lot more, geopolitical uncertainty? I think that's something investors may want to consider.
Yeah, fantastic thoughts from both of you. I do want to shift to Chinese equity markets because, Louis, you recently wrote a piece called Participating in China's Bull Market, where you outlined some sectors that you think are a good starting point. Obviously, we hear a lot of negativity surrounding the Chinese markets, particularly the latest run-up. Oh, it's only because the government stimulated the economy. It's a temporary, rush, and we're going to see a crash on the other end of it. What are your thoughts on the narrative out there right now about the Chinese markets? And walk us through the main points of that article and how you think your average investor could perhaps participate in the Chinese markets.
So how much time do we have? No, I'm kidding.
All the time in the world.
I'll try to do it quick. So look, first, pretty much every conversation I've had on China, people tell me one of two things. the first take is, oh, whatever they're doing is too small, it's too little. It'll just be a sugar rush, as you point out, and it won't have a lasting impact. That's option one. Option two, people say, oh my God, things must be really bad for them to kitchen sink it in that way. Either way, what this tells you is the guy on the other side of the table has not been positioned, of course, for this monster rally that we've just seen. I also tend to believe that most people's mental framework when looking at China is a comparison with what happened in Japan in the 90s and in the 1990s and 2000s. And it's obvious enough why that is. China had a real estate bust. China is having a real estate bust. China had terrible demographics. China has terrible demographics. So it's pretty easy to project the Japanese experience onto China. And again, I think a lot of people have been doing that. But the reality on the ground is extremely, extremely different. Japan was a highly, highly unproductive country. China is running today the biggest trade surpluses the world has ever seen. Japan was stupidly expensive. You remember back in the 90s, you had to check your bank balance before you went out for dinner to make sure you'd be able to afford it. China is crazy cheap. You can go to Beijing today. You stay at the Four Seasons for $200. China is just stupidly competitive. What China's main problem is that confidence has been crushed. That a lot of the massive trade surpluses that China enjoys are not being recycled into the economy. And so I think to be honest, that's how a lot of the stimulus is being set up, is to try to boost the domestic confidence. And one way to do that, of course, is to goose the stock market. So I think a lot of people are looking at this wrongly, because they're saying, look, you need to do this much if you're going to get the economy out of the rut. And then once the economy's out of the rut, then you can consider buying equities. But that's not how it's working, actually. The way that I think the Chinese government is looking at this is, our economy is in a rut because we have poor confidence. So we're going to goose up the equity markets, which will goose confidence, and that will fix the economy. And so it's they don't have the right measures. Now, we can discuss, whether it's going to work, whether it's not going to work, etc. But, our job as investors isn't to decide whether the economy is going to work or not. Our job is to try to make money. And the reality today is Chinese policymakers have clearly decided to goose up the equity markets. I mean, they've put on policies telling companies you can go out and borrow money to buy back your shares, when before share buybacks were a huge no-no. They're actually encouraging share buybacks now. So the policy is goosing up the stock market. From there, you can decide, okay, that sounds like a fun swimming pool. There's a good party here. I'm going to jump in. Or you can decide they're not going to manage to goose up the stock market. But then I come to the question, like, how when you have a printing press, do you fail to goose up the stock market if that's the policy? Now, we can then discuss, they can goose up the stock market, but that's not going to deliver economic growth. But frankly, as investors, what do we care? What we care is making money. And if the policy is goosing up the stock market, then the only question is, what do I buy? If they're going to crank this thing up, what do I buy? And here, I think when you look at China, the big challenge when you look at China is that I think most foreigners, most Americans look at China and think, oh, this is a communist country. I don't want to invest there, etc. But China is actually hyper-capitalist. Take the car industry as an example. There's 130 car makers. So we might decide BYD is going to be the biggest car maker in the world. It makes the best cars. It's terrific, etc. But when you have to deal with 130 competitors, it's pretty tough to expand your margins. So what I like to do when I invest in China is invest in the industries where the level of competition is somewhat limited, and where the barriers to entrance are actually pretty high. So today, what are those industries? The first obvious one is the Macau casinos. It's basically 5 main operators, and there's no new licenses coming in. They have a the 5 of them have a quasi monopoly on gambling for the Chinese market. So I like that. When the government is pushing a lot of money in, trying to get consumption moving again, trying to get tourism going, etc., that seems to me like a promising sector. And by the way, I'm not recommending stocks, but for Americans, there's an easy one to buy here. It's Las Vegas Sands. Boom. You don't even have to go all the way to China to buy stocks. It's trading on the New York Stock Exchange, easy. Again, not a recommendation. Do your own work, etc. The second sector where I think there's limited competition is the education sector. It's a super regulated sector. There was a massive crackdown a few years ago. Share prices went down 90% of the listed guys. And the barriers to entries are now enormous. So the sort of private sector education is, I think, an interesting one that you can look into. The other ones, of course, with the natural barriers to entries are all the big tech names that depend more on network effects than anything. The Tencents, the Alibabas, the Pinduoduos. Now, there is a lot of healthy competition. You look at e-commerce in China, between Alibaba, between Pinduoduo, between JD.com. They're all sitting there crushing each other's margins, but nonetheless, they deal with just a few competitors, not hundreds of them. So that's an obvious one. A fourth one we've already talked about is energy. Massive government interference in energy, very hard for new players to break in. The problem there, but perhaps that's an advantage right now, is it's mostly state-owned enterprises. So you have to be comfortable with the government being the major shareholder in your company. Now, through the life of a cycle, that's not always great because that means the company isn't managed for the benefit of the shareholders. But to the extent that the government has now decided to goose up equity market returns, I don't think having the government as a partner is a bad thing for this point in time. So yeah, a few sectors that people can focus on that I think are interesting at this time when the Chinese government's trying to goose things up.
Super interesting perspective. It's always great to hear something different. You've obviously got boots on the ground. You have office in Hong Kong, so you're there a lot of the time. You're actually in the thick of it, so it's fantastic to hear that perspective. I want to talk about the Fed cutting rates by 50 basis points, joining Canada, Europe, the UK, many other central banks around the world in what appear to be a global rate cutting cycle. I'm wondering what your thoughts are there. What does this mean for the economy and financial markets, and how can investors use this information to position themselves accordingly? David, what are your thoughts?
Well, I apologize. I had the visual up there earlier showing financial conditions, the Goldman Sachs Financial Condition Index, which was actually very easy even before the Fed cut. So that's a pretty odd situation, and not just a cut, but a 50 basis point cut at a time of still very low unemployment and apparently a healthy economy, and very speculative financial markets, very frothy financial markets. So pretty bizarre. But I think in general, when you've got the Fed and other central banks easing into what were already very lax financial conditions, the odds are of certain assets are going to do really, really well. And maybe it's going to be a continuation of the Magnificent Seven. There seemed to be a rotation away from them. And then particularly NVIDIA's come on strong here recently. So I'm not sure that game is totally over, but I do think that if you kind of put all these pieces together that we're talking about, it's probably better to be focused on things that actually benefit from extreme monetary and fiscal stimulus that's going on around the world. And that would obviously be hard assets and other cyclical securities, which have, for the most part, been kind of taken to the woodshed over the last two and a half years. And just to chime in with Louis on China, and he is obviously the expert on that much more than I am, that I did have a chart that somehow disappeared showing the FXI, so the Shanghai Index composite. It broke multi-year support in early 2022. It got clobbered. Then, of course, it's had a monster rally, has corrected pretty hard, which I think is what you kind of look for when there's really a turnaround. And that downtrend that had been in place for so many years is clearly broken. So I think the technical backdrop or setup for the Chinese market's pretty favorable. And I think it kind of fits within this overall theme of investing in areas which are more economically sensitive that do benefit from fiscal and monetary stimulus.
And Louis, your thoughts on the rate cutting cycle and how investors can position themselves accordingly?
Yeah, look, I think for me, what was fascinating is when the Fed cut 50 basis points, the US dollar went down. When the PBOC cut, the renminbi went up. And, PBOC cut a couple days to the Fed. And to me, that was a very strong message from the market. And to Dave's point about the Max 7, I think the reason this matters is that to a large extent, I tend to believe that the Max 7 were a strong US dollar play. They were a recipient for all the excess dollars in the system. That, the Chinese, the Koreans, all those places that kept earning too many dollars, didn't know what to do with them, didn't want to put them in U.S. Treasuries anymore because the government's issuing another $2 trillion a year. So if you've got excess dollars, you think, oh, what do I do with these? Tell you what, I'll just buy Microsoft. It's buying back shares. It's got positive cash flows. It's going up. So why not? So Microsoft, Apple, Google, all those places were recipients for the excess dollars in the system. To the extent that the Fed is now cutting and the perception is, oh, the US dollar is no longer going to be going up and it's likely to go down on bad news because on bad news, the Fed's going to cut more. If that's the new cycle, then all of a sudden, do I need to stay in the Max 7? Maybe not. And yes, to Dave's point, I can start looking at other assets, both within the US and outside the US. And so that brings you into the fact that all of a sudden, here we are, in October. And if you look at the Max 7, you only have 2 of them now that outperform the S&P 500 for the year. 5 out of 7 are actually underperforming the S&P. While they led for the first half of the year, all of a sudden, today as we're taping, we're making a new high on the S&P 500. But most of the Max 7 are not making a new high. And this is a big change from where we've been for the past really decade, where each new high on the S&P 500 was actually preceded first by a new high on the NASDAQ and was actually preceded by new highs on tech. So I think, we're starting to see the rotation. And for me, the interesting rotation there is that look at your typical deflationary boom assets, the assets that go well, not because of rising prices, but because of rising volumes. There's 2 main deflation. Bull markets in general can be driven by one of 2 things. They're driven either by tech or they're driven by financials. And it seems to me that in the past few weeks, we've started to rotate away from a market driven by tech to a market driven by financials. And you're seeing this today is a perfect example of this, where all the banks are up 2, 3, 4%, and tech is going nowhere. I think there's an important rotation happening here, and time to start fading the tech and buying other things, as Dave pointed out.
Yeah, to that point about financials, we flagged this in our newsletter, and Louis and I exchanged some emails on it a month or 2 ago when XLF broke out, the U.S. financial ETF, a very impressive breakout, but actually it was very much of a global phenomenon. Basically, financials all over the world have been breaking out, I guess with the exception of China, but at least there you got the broken down trend I talked about earlier. So yes, I think that's a positive development. Usually you want to have good participation by financials to have a true bull market. So, there tends to be this discussion of it's so binary. It's like we're going to have this never-ending bull market or we're going to have a big bear market. But what if we have a market more like the early 2000s where we moved away from, what had been the Magnificent Seven, whatever the number was back then, really probably even a greater tech bubble than we've had recently, and toward more traditional areas, which included financials and natural resource producers and energy, which obviously falls in that category. So yes, I think that's pretty encouraging, and there are places to make money. I think another area that looks really interesting is what's happening with mid-cap value, which had been a laggard as well, and it's broken out impressively. Small caps breaking out. So there are definitely places to make money. I just don't think they're the same places that you've been making a lot of money for the last couple of years, and I suspect Louis agrees with that from what he's just said.
Well, I am going to swap out the final question I was originally going to ask and ask a different one, because this is a question I was actually going to ask both of you after we were finished recording. And I realized, why don't I just ask it for the benefit of our viewers as well? And that is, where can we get yield now on our cash? I've been rolling over my cash in short-term T-bills, and I've been watching that percentage go down in Canada. It's starting to tick down in the US as well, below 5% on the 90-day. Where else can we put cash right now to work for yield? Is there emerging market bonds that look attractive? Do corporate bonds of any kind look good to both of you right now? What are your thoughts? And David, I'll start with you.
Yeah, well, that's a great question because I do think that the whole T-bill and chill strategy, if you will, got overused. And it was just so alluring just to sit in there at, 5.5% with no risk. And, when the yield curve got deeply inverted, you kind of get that old knee-jerk reaction from investors. Is like, why should I go longer term to get a lower yield? But that's what happens when you have inverted yield curves. It happens at the end of every economic and tightening cycle. Now, maybe we are getting the soft landing, but you're still seeing the yield curve kind of uninvert. And if we are going into a global interest rate cutting cycle, which I think we are, I think that's pretty clear. If you look, around the world, I think it's one of the most aggressive rate cutting cycles we've seen. And so you should be looking at ways to lock in yield. And I think emerging market debt is a great example of, if you look at, for example, 10-year Brazilian bonds, government bonds are about a 12% yield in local currency, and their inflation rate's running kind of in the 4.5% range. So you've got a Paul Volcker-like real return, the kind of real return he created here in the early 80s. So that's an extreme example, but there's a whole lot of other emerging markets that have very high real interest rates. And what's interesting, because they're perceived to be so risky, but if you look in aggregate, emerging market debt, government debt, is about 65% of GDP, and it's more like 100% plus in developing worlds. In the U.S., we saw that earlier charting, and that works out to be about 125, 130% of U.S. GDP. So and for the most part, these countries run trade surpluses rather than our twin deficit, which the last I saw, and Louis can correct me if I'm wrong, I think it's running at about 11% between the federal budget deficit and the trade deficit. It's huge, and we've now become, the world's biggest debtor country. And we've also got negative national net interest rates, net savings, which typically only happens in a bad recession, in a crisis. So another one of these examples of just things are really out of balance. And I think so much of it has to do with this federal spending that's completely out of control. So I think you're right. I think it makes sense to be looking in other places than the U.S. for your best yield opportunities.
Darn it, Dave, you stole my Brazilian bonds.
I knew you were going to go there.
Well, look, I had one more thing on the Brazilian bonds. The very day that the Fed cut rates, the Brazilian central bank was hiking theirs. So you've got one central bank that doesn't really worry about inflation, and one that does. And as a bondholder, I think you always want to be with the central bank that does worry about inflation rather than it doesn't. So look, I think that if you're going to own bonds anywhere, the real threat is always inflation. Where will inflation come from? If inflation comes from at this juncture, it has to be what we discussed, through a big rebound in oil prices, which I think is a real threat. So the first thing I'd say is you probably want to own bonds in currencies or in countries that will benefit rather than be penalized by the high oil price. Now, Brazil definitely fits in that category. Others do as well. Colombia does, and Mexico does, and even South Africa. So yeah, I completely agree with Dave. There's lots of things interesting in the emerging market space. Now, of course, not everybody has emerging market debt. So close to home, if you look at the real risk to the inflation outlook, is a spike in oil prices. How do I hedge myself against that? Maybe I buy MLPs. That today still offer very high, decent dividend yields. And if energy prices spike up, I'll be somewhat protected. So that's perhaps another destination for cash where you can pick up some yield. In fact, if you look at energy complex, there's lots of ways to pick up yield.
So to Louis' point, if you are a believer in the natural gas bull story that I articulated earlier, I think some of these natural gas trusts, where you get a variable dividend, so it's not like it's a locked-in kind of thing, but with natural gas prices trading kind of in the 250, 260 range, I think there's a lot more upside to natural gas prices. Certainly, if you look at the futures curve, which is in deep contango, meaning the futures prices are way higher than spot prices, that would indicate that these guys can actually go out there and lock in prices in the 350 range. And So these royalty trusts, which have cut their distributions because of the big plunge in natural gas prices, could actually see distributions go up nicely. The yields are still pretty good, even at this level. So I think that, and there's one of them that Louis knows quite well too. I won't mention the ticker because that gets our compliance people into a dither, but it's had huge insider buying here recently. And yes, there are definitely opportunities in energy where you can get both yield and growth. Nice combination.
Well, gentlemen, this has been a fantastic conversation. Once again, so many insights shared. Thank you so much for coming on the show once again. If both of you could just let us know where the best place is to go to find more from you online. David, I know you've got a fantastic newsletter. Why don't we start off by talking about that?
Sure. Well, for now, you can just find us at Substack. I'm not sure we're going to stay at Substack for a variety of reasons, but you can find us there. And you can also go to the Evergreen GovCal website, where you can access us as well. That's really my day job is, as you said earlier at the outset, co-CIO, along with Jeff Dix of Evergreen GovCal. So yeah, pretty easy to find. And we do put out some free content every week. So for people that just kind of want to do a sampler or a taste, you can do it that way.
Fantastic. And Louis, you do some fantastic writing as well at GavaCal. Is that the best place for people to go to find your work? Is there anywhere else you'd like to direct people as well?
Absolutely. The best place is our website, gavekel.com. I do post things on Twitter every now and then, so you can look for me on Twitter. But otherwise, yeah, the website is definitely the easiest place.
Okay, I'll put
And
links
Jesse,
to
I should
all
add
of
that
that
it's
below. Yeah.
I should add that when you go to Substack, you should search under Haymaker. Not necessarily.
Yeah,
David Hay would probably work too, but Haymaker is the best.
Yeah, there'll be a link in the description below to your Substack, as well as to gavacal.com and evergreengavacal.com, so people can check that out. Thank you once again, gentlemen. It's been a blast.
Thank you, Jesse. Let's do this again.
Thanks for having us.